reports, the 12th of November 2025. Okay, let's see what's in store for us today. Now, today I'll talk about the BOJ's next rate hike, what the latest summary of opinions tells us, and how Sanaenomics could shape the yen. Okay, so the Bank of Japan's latest summary of opinion has done something markets have been waiting for all year. Now, it offers the clearest snapshot yet of how rate setters are leaning in effect sketches out a rough timeline and clear conditions for the next rate hike. Now, at the October 29th, 30th meeting, the Bank of Japan held its policy rate at 0.5%, but the debate was clearly shifting. Now, two board members, Hajime Takata and Naoki Tamura, again voted to raise the rate to 0.75%, and the summary shows that 8 out of 13 submitted policy opinions either called for raising rates in the near term or laid out specific conditions for doing so. One anonymous member summed up the mood. It is likely that conditions for taking a further step toward the normalization of the policy interest rate have almost been met. Okay, so what the summary of opinions actually say. Now, like mentioned just now, 8 of the 13 submitted policy opinions called for raising rates in the near term or setting the specific conditions for a hike. One member said conditions for normalizing the policy rate have almost been met, while another urged not to miss the timing to raise rates. So 9 people vote on rates, 13 opinions are summarized in the document. Among those 13, 8 lean towards a hike or set conditions for one. So this is a broad hawkish tilt. So the key message from the October meeting is this. Now, 3 things stand out. First is the next hike is near but data dependent on wages. Several members argued that conditions for normalizing rates are almost satisfied, with a particular focus on whether firms will keep lifting wages in the next spring shuntō wage negotiations. Now, second is financial conditions will stay easy even after the hike. Now, one opinion explicitly said financial conditions would remain accommodative even if the Bank of Japan takes a further step, widely interpreted as an increase in the policy rate from 0.5 to 0.75. That tells you the board is thinking of a gradual hiking path, not a Volcker-style shock. Number 3, risks from global economy and US tariffs. Members flag uncertainty from high US tariffs and global growth, arguing for caution not to tighten into a sharp external slowdown. So in summary, the center of gravity on the board has shifted to hike soon if wage momentum survives into spring 2026, with a possible move as early as December if data cooperate. Now, what it means for policy, Bank of Japan versus Sanaenomics. This hawkish drift at the Bank of Japan now collides with a very different fiscal stance under Takaichi. Now, the core of Takaichi's economic policy is based upon 3 pillars of proactive fiscal expansion, right? Cautious attitude towards rate hikes, and heavy defense and strategic spending. Now, crucially, none of this above that I just mentioned, these 3 pillars, looks like fiscal austerity. It's not about saving, it's about spending. Okay, so it points to more stimulus and more Japanese bond supply and not less. Right? So here is where the Bank of Japan aligns with Takaichi and where they collide. Now, the alignment is this: both of them want wage-driven inflation, not just imported prices shock. They both watch wage settlement as the key trigger for declaring mission accomplished. This is where the misalignment is. Bank of Japan is now openly preparing the ground for a near-term rate hike, provided wage momentum holds up, whereas the new PM prefers caution, arguing that hiking too soon could choke off fragile real wage gains and consumer spending. So for market, the tension matters. A prime minister who leans on the BOJ to stay dovish at the same time as she ramps up fiscal stimulus is by default yen negative unless the Bank of Japan pushes back strongly. So what it means for the yen short-term, medium-term, the short-term takeaway, the October summary reduces the risk of no hike, but it doesn't guarantee an immediate sustained rally for the yen. Into the December meeting, the yen is likely to trade as a binary event currency. Now, what do I mean by that? Clear signals of December hike plus firm wage data means a yen bounce back. Yen will appreciate in value. Delay into 2026 and big fiscal package means renewed yen weakness. Okay, so in the short term, early 2026, this is what we expect. Now, for the medium term, there will be multiple scenarios. So like the scenario one, we call it the orderly normalization. Bank of Japan hikes to the 0.75% in December of quarter one and guides to a slow path of further moves if wages stay above 3%. Now, Takaichi's fiscal package is large but credible time limit with some emphasis on productivity investments rather than pure consumption subsidies. So for the yen, how it's going to move like in that way, the US Japan rate gap narrows at the margin as the Fed cuts and the BOJ edges up. So the dollar yen pairing could grind lower over time, driven by shrinking carry and carry as in carry trades, and some repatriation flows rather than a violent snapback. Okay. For scenario two, we call it the fiscal dominance. The BOJ hikes once, then pauses for a long time, emphasizing caution and downside risks from US tariffs and global growth. Meanwhile, Takaichi's pushes through larger than expected stimulus and accelerated defense spending funded mostly by new bonds. So for this, the result for the yen, Japan runs easy monetary plus easy fiscal at the same time. Real Japanese rates remain deeply negative and carry trades remain attractive. The yen likely stays under pressure, with periodic spikes stronger when markets fear intervention or global resolve. Okay, so that's it. And scenario three, we have policy clash and market volatility. BOJ sees clear wage-driven inflation and accelerates normalization more than market expects. Takaichi under political pressure over rising mortgages and small medium industry borrowing costs leans on the Bank of Japan to slow the pace of tightening or signal unease about additional rate hikes. And the result for the yen for this scenario, the market could price in both, whereby higher near-term rates, which is supportive for the yen, higher political risk premium and concerns about central bank independence, which is negative for the yen. So it depends on the narrative, okay, at that moment. So the near-term effect is there is more volatility in the dollar yen with sharp two-way moves around every Bank of Japan fiscal headline. Okay, so this we will need to see which scenario plays off and have a closer look into it, and see how things work going forward for the yen. Okay, the dollar yen. With that, that's the report for today.